Hey everybody, welcome back. In this podcast, Budgeting Schedules, Freja Inc., we'll look at a complete end-to-end example bringing it all together. We'll follow the journey of Freja Inc., a fast-growing startup that designs and sells handbags, work totes, and travel accessories. You'll see how Freja's leadership team, with the help of their newly hired finance professional, builds out a full set of budgeting schedules to guide operations and cash flow decisions for the year ahead. I'm Professor Jeff Byrne, and I'm excited to be with you. We'll start with the backstory of Jenny Lee, Freja's founder, and the challenges the company faced in year 2. We'll walk through each step of the master budget, from sales forecast to production, direct materials, labor, overhead, and SG&A. We'll use Freja's realistic assumptions and numbers to create the full set of schedules. All of these schedules will be used to create the company's projected cash budget, pro forma income statement, and pro forma balance sheet. We'll show those 3 statements in the next vodcast. Together, this is your chance to see budgeting in action start to finish. Jenny Lee, age 28, is the founder and real CEO of Freja Inc., a fashion-forward startup based in New York that was recently featured in CNBC's Make It series. She launched the company 4 years ago to sell functional, stylish handbags and travel accessories. In year 2, Freja saw explosive sales growth, but Jenny quickly found herself in a cash crisis. She had spent heavily on materials, labor, and production to meet demand, but customer payments, they were coming in slowly. Despite being profitable on paper, Freja was almost out of cash. In early year 3, Jenny brought in a small team of experienced finance professionals. Their job? Build a plan to stabilize operations and ensure Freja could manage growth without running out of money. Now the team is putting together the Year 4 master budget, a detailed roadmap that includes quarterly forecast, spending plans, and a cash flow projection to guide each and every decision. What you'll see next is the budgeting process they likely followed. The budgeting process begins with ending balances from the prior year on the balance sheet from the prior year. These become the starting point for the new year. As of December 31st, year 3, Freja closed the year with $450,000 in cash, $300,000 in account receivables, $122,500 in raw material, a total of 3,500 units at a price per unit of $35. Finished goods, $142,500, altogether 1,500 finished goods at a cost of $95 per handbag to make. Property and equipment total $650,000, less accumulated depreciation of $120,000, gave us net plant and equipment of $530,000. Altogether, assets totaled $1,545,000. Claims in those assets, $288,000 in total liabilities for accounts payable, common stock of $500,000, and an impressive retained earnings for the first 3 years of $757,000. It's important to note that all of this flows directly into the opening balances for the year 4, setting the stage for the budget we're about to build. Before diving into the numbers, Jenny's team met to define the key assumptions for the company. We're going to keep things simple and use averages for all the products. First, the sales projections. Jenny's team projects that they'll sell 45,000 handbags over the next 4 quarters, 5, 10, 10, 20, altogether 45,000. They also went ahead and projected 5,000 and 10,000 for quarter 1 and 2 of the next year. Handbags sell on average for $200, and for the sales, they'll collect 50% of those sales in the quarter of that sale, the other 50% in the quarter after the sale. From a production standpoint, Jenny's team would like to build out a 30% cushion of whatever they plan to sell in the next quarter. Each handbag uses on average 1 yard of leather, which costs $35 per yard. Freja pays for 75% of the materials in the quarter they purchased, and the remaining 25% in the following quarter. Now, each handbag takes on average 1 hour of direct labor, and the workers are paid $38 per hour. Overhead is $11 per unit variable, plus $123,750 per quarter in fixed, and this includes $25,000 in depreciation. SG&A includes variable component of $30 per unit and fixed expenses of $375,000 per quarter, including things like marketing, administration salaries, insurance, plus $15,000 in depreciation. Finally, the company plans to purchase $200,000 of equipment each quarter and paid $250,000 in dividends in quarter 4. They also plan to keep a minimum balance at all times of $250,000 per their arrangement with their banker so they can get a $1 million line of credit. That line of credit will carry a 2% interest per quarter. Amounts drawn on the line of credit will be in $1,000 increments. All borrowings will be assumed to be at the start of the quarter, and at the end of the year is when interest will be paid, and any repayment on the principal borrow will also be made should the cash position allow. The first step is the sales budget. Jenny's team forecasts quarterly sales as follows: 5,000, 10,000, 10,000, 20,000 for each of the quarters, for a total of 45,000 units at $200 apiece, altogether a total of $9 million in sales. Next, let's take a look at the schedule of expected cash collections. You may recall that on the beginning balance sheet, there were account receivables totaling $300,000. Those are assumed to be collected in quarter 1, so $300,000 is where the expected cash collection begins. You may recall from the assumptions that Jenny's team expects the sales to be collected 50% in cash this quarter, 50% of the next quarter. So $1,500,000 quarter 1, $500,000 quarter 2. The total expected cash collections for quarter 1 are $800,000. Following that same pattern of 50% and 50% makes quarter 2 $1,500,000. For the $2 million projected in sales for quarter 3, 50%, 50% makes the projected cash collection $2 million in quarter 3. Quarter 4, $4 million, $2 million is collected this quarter, $2 million is collected in the first quarter of the next year, meaning there's an ending account receivable balance at the end of quarter 4 for uncollected amounts of $2 million. With projected sales in hand, Jenny's team mapped out production. Freja aims to end each quarter with 30% of next quarter's sales in finished goods. This is to help avoid stockouts, but at the same time not lead to overproducing. Let's go through an example. Budgeted sales for quarter 1 were 5,000, plus they want to have 30% of next quarter's made in this quarter as well, altogether 8,000. But they already begin this quarter with 1,500 units on hand from the end of last year, so they only need to build 6,500. Quarter 2 follows the same pattern. 10,000 plus 30%, 13,000, less what they begin with at the end of quarter 1, which goes into quarter 2 of 3,000, means 10,000 needs to be produced. Same pattern for quarter 3. Going into quarter 4, the same pattern, 20,000. And now they want 30% of quarter 1 for next year as a cushion to be built in quarter 4, so that makes 21,500. Less the 6,000 that they start out quarter 4 with, which was the planned ending for quarter 3, means they have to build 15,500 in quarter 4. Notice the ending quarter 4 units of 1,500. We'll multiply that times the eventual cost per unit to figure out what the ending inventory balance of finished goods happens to be. Next up, the direct material budget. We have the required production from the previous schedule, 6,500, 10, 13, and 15.5. Every single unit requires 1 yard of material, so altogether the total yards needed are listed here. Like finished goods, they also want to end every single quarter with a little buffer of ending raw materials so they don't have stockouts as they begin production in the following quarter. The assumption is they want 30% of next quarter's production needs to be available in raw materials at the end of quarter 1. That makes 9,500 yards needed. less the 3,500 yards that they began with per the beginning balance sheet means raw material purchases need to be 6,000. At a cost of $35 per yard, they'll spend $210,000 to purchase raw materials in quarter one. Now the schedule of cash disbursements for raw materials, well, they ended quarter four of last year owing $288,000 for raw material purchased in quarter four of last year. That's getting paid first in quarter one of this year. Then the purchases for this year of $210,000, 75% of that, or 1,575, is paid for in this quarter, and the other 25% is paid next quarter. Altogether, the total amount of cash to be dispersed for raw materials in quarter one is $445,500. Same pattern for quarter 2, 3, and 4. For quarter 2, they have cost to buy all the raw materials, $381,500. They'll pay for 75% of that now, plus they have 25% they still owe from last quarter's purchase of raw materials, means the total is $338,625. $456,313 for quarter 3, and $456,313 for quarter 4. It's worth noting, out of the $448,000 they pay for raw materials in quarter 4, they only pay $336,000 of that. The other $112,000 of that will become an accounts payable at the end of quarter 4, which will be paid next quarter. Note also that the desired ending raw materials 1,950 yards at a price of $35 per yard gives us the amount of raw materials that will appear on the ending balance sheet for the year of $68,250. Moving right along with the direct labor budget, and this is really straightforward. We have the hours of production required from the production schedule. Every single handbag takes 1 hour of time to build. Total hours times a rate of $38 per hour gives us the total direct labor cost. Now, manufacturing overhead. We have the direct labor hours for every quarter. There is $11 of variable cost per direct labor hour. $1,500 is the total variable cost for quarter one. There's $123,750 of fixed cost every quarter, making our total manufacturing overhead cost for quarter one $195,250, with similar numbers for quarters 2, 3, and 4. There is $25,000 of depreciation per quarter, so our actual cash paid per quarter is listed below. For quarter one is $170,250. From here, we can also calculate what the predetermined overhead rate is. Notice if we take the total manufacturing overhead of $195,250, $233,750, $266,750, and $294,250, that totals up to $990,000. We are allocating this cost over our cost driver of labor hours. Our total projected labor hours for the year are 45,000. That means our predetermined overhead rate would be $22. So for every handbag made, we'll assign $22 of overhead. That plus the direct material cost and labor cost will give us the total unit cost per handbag. That unit cost can be summarized here. Every handbag takes 1 yard of material at $35 for a total cost of $35. Every handbag takes 1 direct labor hour at a cost of $38 for a total direct labor of $38. Every handbag gets assigned $22 of overhead cost, meaning that the unit product cost for 1 handbag averages to $95. We plan to have 1,500 handbags left in our ending finished goods inventory at $95 each. Our finished goods balance at the end of the year should be $142,500. The very last schedule for Freja is the SG&A expense, or the S&A expense as it's stated here. We have our budgeted units, and we have variable cost and fixed cost. Variable cost is $30 per hour, gives us our total variable cost of $150,000, $300,000, $300,000, and $600,000 for the 4 quarters. Fixed is $375 per quarter, which gives us the following total S&A expenses for all 4 quarters. We have included in this $15,000 of depreciation, so now we have the cash that's actually going to be paid for S&A expenses for each of the 4 quarters. Well, let's recap what we've done so far. In this vodcast, we followed Freja Inc. through the first major phase of their 4-year planning process. We started with the beginning balance sheet, which gave us the company's starting financial position. Then we defined the budgeting assumptions sales expectations, cost structures, labor requirements, and planned investments. From there, we built each of the initial master budget schedules, including the sales budget, Schedule 1, production budget, Schedule 2, the direct materials budget, Schedule 3, direct labor budget, Schedule 4, manufacturing overhead budget, Schedule 5, ending finished goods and inventory budget, Schedule 6, and the SG&A expense budget, Schedule 7. These schedules tell the story of Freja's operations, how many handbags they plan to sell, how many to produce, what it will cost, and when the cash will go out the door. In the next vodcast, we'll take these schedules and use them to build a detailed cash budget, a pro forma income statement, and a complete budgeted balance sheet. By the end, you'll have a complete professional level budgeting example, one you can reference for case studies, classwork, and even your job perhaps before the semester's over. Let's go.